Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Wednesday, June 7, 2017, looking at a daily chart of the SPY, or SPDR, which is the proxy for the S&P 500. And as you can see, it's kind of like the band is playing on, or the band plays on. All we're doing is continuing to trend sideways to lower, but in a bullish pullback pattern fashion in these upper ranges of the SPY or the S&P 500. So a little bit of back and forth, a little bit of down early on, a comeback, and all it amounts to is a little bit of a downsloping day, a bullish pullback pattern, and that's really all that's developing. So the market could decide to go higher tomorrow, or it could pull back for another couple of days. But either way, whether it's tomorrow or next Monday, the market should have another leg higher, and it's going to do this along the way. It's going to go up for a couple of days. It's going to pull back. It's going to go up for a while. It's going to pull back. And right now, we're in a pullback pattern, but there's nothing wrong with this market. This is a bullish pullback pattern. There's buoyancy in this market, and that tells you that the cycle is still going higher, meaning the cycle has not completed in terms of a turning related event. So what I'm saying is we're trading up into the culmination of a cycle date, and we just haven't got there yet. So it's price and time is more important than price, and I believe that we haven't quite got there in time. There could be another month or so remaining on the clock. Doesn't have to be, but there can be. So on very light volume, less than 50 million shares, the SPDR goes up a little more than 0.1%, and at the end of the day, it amounts to a flat day. And here's another flat day where you have the IWM really continues not to have the same look as the SPDRs, right? So the SPDRs are trading in the upper range, and when you look at the IWM daily chart, there's a possibility that we put in another lower high. And if that's possible, then we could trade downward, but we did get above the moving averages. That's positive. We did get above and close above now 2 days in a row, the 138.60. That's positive. So there's more positive leaning information in the IWM chart than anything else, but it was the laggard today against the SPDR, if you really want to call it that. They were within about 0.1% of each other, so we can't really make a mountain out of a molehill, and we're not going to do that. But they are in a relatively bullish position compared to where they were, but they're still lagging compared to the SPDR in terms of the daily chart. So we just need to keep that in mind. But on a short-term basis, as long as we remain above 138.60 on a daily chart closing basis, that's bullish. Close back below, it turns a little bit negative, back below the moving averages, and there's something wrong and we're going lower. And that's the way I'm looking at the IWM right here. Now, when you look over at the transports, we had a decent up day in the transports, up over 0.6%, and you can see us already beginning to break out of what was only a 2-day consolidation. Well, that's not enough time to really break out, so the market would need more time. The transports would need more time to consolidate, and maybe they get it, or maybe we just go up a little further and then stall out at the highs above 9,400. But either way, in a bullish position above the moving averages, the transports are in a better position than the IWM, and I like to compare the two because they are my two favorite leading indicators across the markets. But as a leading indicator, it is in a bullish position. Well, let's put it this way. More bullish than the IWM, less bullish in terms of the look of the chart than the SPDR. We're still not near the old highs in the transports, while we are at the highs in the SPY. So there is still a divergence between both of our leading indicators and the S&P 500. And that also coincides with the breadth of the market. And I've talked about this before. The breadth isn't great, meaning the market's been rising, the NASDAQ in particular, and the S&P have been rising on less and less participation from a broad scale, less and less broad participation from stocks across the entire, or all the sectors, I should say, and more of a market levitating on the strong select few that are widely owned that are driving the market higher. And that's really what's indicative of what happens at the end of a rally. That's the type of information that becomes available and that you want to pay attention to, because it's easy to look back after the fact and say, oh, well, the breadth was terrible up here. That's 10% ago. Well, look at it now and say, it's not healthy for the market to be rising like it is when the breadth is not more balanced across the board. So we know that that's typically not indicative of a broad spread, broad-based institutional participation market rally. So we know that this is the culmination of something, at least that's the way I read it, but we're just not ready yet. There's more upside coming any way you want to look at it over the next, let's say, 4 to 6 weeks. All right, enough with the markets. Let's go over to the gold market. And gold pulled back today, finishing down around $8, a little more than 0.5%. And you can see what happened is we had somewhat of a exhaustion day yesterday. It wasn't quite an exhaustion day because the volume wouldn't dictate exhaustion, but we had an up day and the market finished at the highs, and that's generally a sign of either exhaustion or there's some follow through to come. Well, either way, whether it was exhaustion or not, we came down today to back test the 1286.60 level, give or take a few cents on either side. And that's common and normal market behavior. That was resistance on the way up and will become, and has become at least temporarily for today, support on the way down. The question is, will gold put in a sideways consolidation pattern for higher prices, or will we have a more meaningful pullback from where we are now? And it just turns out that from the most recent pivot low down here, this was the 21st day since that pivot low, counting that pivot low. At least that's the way I counted it. All right, moving over to the silver market, and we saw a similar pullback in silver today, coming back down to test yesterday's lows, finishing above that level, but also being contained by the overhead resistance that we talked about in the 200 period moving average that came in at around 1774, give or take. So we talked about that a couple of days ago, that would be overhead resistance. That is overhead resistance for now. The question is, do we put in a sideways pattern, building some energy for another move higher, or more meaningful pullback? Same conversation we just had with gold. We need more time, more evidence. Silver was certainly overextended from a short-term perspective and needs to pull back and consolidate for a while, work off some of the overbought condition that developed. When you look over at crude oil, crude got thumped today, and we're down below the 45.92 level. So we're going to be looking for a reversal somewhere. My indication would be that crude oil will bottom and reverse inside of the former low. So a few weeks ago when crude, and this was only a few weeks ago, it's made this round trip. It was just May 5th. And here we are, June 7th. And in 30 days, basically, we went all the way from a low of, and this is just interesting, 44.10. And that's on this contract. I know the previous contract was slightly lower. It was 43.77, I believe. But this contract, it prints a higher number. 44.10 up to a high of $52 and all the way back down below 46, all inside of a 30-day period of time. That's some round tripper. But nevertheless, I think we'll find bottom inside of 44.10. So I'm looking for this to be a retest and to find some kind of another low point, and maybe it puts in another lower high. That's certainly possible after a bounce. But right now, I have to believe that with the type of volume we saw today and the type of down day being down over 5% in crude oil, we should be coming into another exhaustion point on the downside, and I'm looking for crude to make a low inside of the previous low. We could pierce it intraday, but I'm not expecting a close below the low from May 5th. So I'm looking for a turn to occur in the next day or two. So that's your story in crude oil. Coming into an interesting level, we should be coming into a tradable area. I just need the signal. We need the market to give us the high sign, because you don't want to be caught on the wrong side of crude oil. So I'm waiting for the sign of a trend change in crude oil. Looking over at the bond market, same routine in the bond market. We're just running into this resistance point at 155.1 that we cited, put on the chart, and wound up to be resistance. And now we've traded sideways right underneath that for about 4 days now, counting the initial day higher. That tells me that bonds want to go higher. It tells me we're consolidating to make a higher or another move higher in the bond market, which would push yields lower. And that's interesting, again, since the stock market seems to be struggling to make higher prices yet again. While today's day was relatively flat, we are, at least in the S&P, hovering near the all-time highs. Looks to be consolidating to move higher. The question is, how high is the bond market going to go and the stock market going to go in tandem or simultaneously before one of them has to revert back to its mean and where it should be in relation to the other based on the current market conditions? And I know that that sounds like a bunch of hogwash, but the reality is we're not in a state in the economy or the financial markets today where markets are stressed to the point where yields are being pushed lower for obvious reasons. Maybe they're being pushed lower for a reason, but they're not obvious to the naked eye right now. Nothing really materially has changed in character across the markets from where it was a month or 2 or 3 or 6 ago. And that's why I say that it's just a little strange that the bond market continues its trek higher and the stock market at least hovers around all-time highs. Something is going to give in one of these two markets, or something will become more clear, and we'll have that discussion when and if that does happen in the near term, and it should be in the near term. And the last market we'll cover tonight, and we're kind of running through this a little faster than the norm, but the markets are what they are. It was a relatively quiet day, and we saw a little bit of a round tripper in the dollar, but at the end of the day, and I hate that term, at the end of the day, but at the end of the day, nothing happened in the dollar. We basically finished flat, and we still may have to just have one more flush lower to do a throw under near the bottom portion of this trend channel, and that would be a good area for the market to make, and the dollar market that is, to make a bona fide reversal and a trend change, put in a bona fide signal of a trend change, and then it would be free to move about the charts in the higher direction. And with that being said, I'm going to leave it there tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.